Stock Markets for Beginners, Part 5. We're going to talk about ETFs, index funds, and mutual funds, the similarities, the differences between each of those, and we're going to break down REITs, real estate investment trusts, and why many investors may want to choose one of these investment vehicles to go ahead and place their dollars in because they don't take as much work as individual investments. And this is a very, very important section that you're going to want to watch all the way through. So if you like this content, make sure you subscribe to this channel. And if you want even more content, make sure you join the exclusive Patreon linked down in the description. And without further ado, let's go ahead and jump right in. What is an ETF? An exchange traded fund. So an ETF is a tradable financial instrument that allows you to purchase a small portion of a diverse bundle of multiple securities. So ETFs can track a ton of different things, like an index, a sector, a commodity, or any other asset. We're going to dive into this so you can completely understand this. Just don't check out. Don't check out. You'll understand it in a minute here. So the most popular ETF is the SPDR S&P 500 ETF. SPY is the ticker symbol. Buying a share of SPY actually gives you a small little slice, a small little portion of the 500 largest companies in the United States. So we have a share. Remember, that's a small slice if you were to buy one share of any one of these 500 companies. One share of the SPY ETF gives you an even smaller slice of 500 companies, the 500 largest companies. So it gives you this nice diversification. So here is an example of a stock versus an ETF, not to be confused with livestock. You know, these are supposed to be cows, but now that I look at it, it kind of looks like I drew a goat. But anyways, so buying an individual stock, it's kind of like buying one cow. So let's say you have $100. You want to get into the milk game. The milk game is hot. So you have $100. You could either buy one cow for $100, or you could put a $100 stake in for 10 cows. So what happens here, if you have one cow, it's more volatile. That cow could produce more milk one day, less milk the day after that. You don't know what's going to happen. It's less predictable. But if you have 10 cows, you know the average of those 10 cows could give you a more predictable return. That is kind of like buying into an ETF. You get a little bit more diversification. You get a little bit more of a consistent return. There's going to be fewer low lows and fewer high highs as far as what your return is in that investment. And then we have an index fund. An index fund is a type of ETF that is built to match or track a financial market index. So a market index is a bundle of securities that represent a category in the financial market. So some examples of this could be a large cap stock, so stocks with a huge market cap, or small cap stocks, stocks with a small market cap, or growth stocks, value stocks, consumer defensive stocks, tech stocks, any number of categories that we already mentioned. This could be an index fund, and there generally is already an index fund on anything you could think of. There are so many index funds. So two popular index funds are the Dow Jones Industrial Average and the NASDAQ Composite Index. So when someone says, oh, you know, the Dow is down 0.5%, they're talking about the Dow Jones Industrial Average Index Fund being down 0.5%. Same with the NASDAQ Composite Index. So now when someone says, oh, the NASDAQ is up 1%, you know exactly what they're talking about, and you can come back and say, thanks, I sounded smart by the water cooler today at work. And then next we have mutual funds. Mutual funds are similar to an ETF, but it's a professionally managed financial instrument that pools money from investors, similar to an index fund or an ETF, but it aims to beat market returns, not match market returns, by purchasing a variety of different investments like stocks, bonds, or other assets. So mutual funds, like I said, are similar, but their performance is based much more on the fund and the fund manager's success than specific assets or a specific index performing well. And typically mutual funds, even though there's someone there trying to make the best return possible, typically they return a worse return than an ETF or an index fund unmanaged in the long run. It's nearly impossible to beat the market in the long run. Now, I know it's confusing with the differences between mutual funds, index funds, and ETFs, so I made this handy Venn diagram. Is it a Venn diagram if there's three? So I made this so we can tell all the similarities and the differences between an ETF, index fund, and mutual fund. So let's go over this. We're going to start in the middle with the similarities between all three. So first, investors are pooling money. So with all three of these, many investors from all over the world are pooling their money to give some more buying power in these individual funds. They also all are a way to hold many different securities. Remember, it's the difference between buying that one cow or buying the stake in 10 cows, and they all help you diversify by being able to be in all these different securities or asset classes or whatever the ETF, index fund, or mutual fund is that you're buying into, whatever the focus is. Now, if we go to the top left to what is unique about ETFs, we can see ETFs can be purchased anytime during trading hours. So that's different than index funds and mutual funds. With index funds and mutual funds, they can only be bought or sold once per day. At one time per day, those trades are executed. With ETFs, also, there is a very low investment amount. Typically, there is no minimum amount. You can invest $1 if you want to. And the average fees with an ETF are 0.44%. Now, if we go to the top right to the unique criteria of index funds, we can see the minimum investment amount varies. It can be zero in some cases, but it also can be as high as $3,000. So you may have to, depending on the index fund, buy a minimum of up to $3,000 in order to buy a chunk of that index fund. The average expense fee for index funds is the lowest of all three, with 0.09%, because they're largely unmanaged. They're a low fee way to diversify your money. And index funds really are the best place for most people to plunk down their money if you don't want to spend hour after hour tracking individual stocks and investments and trying to beat the market, which nearly no one can do. Index funds are a great option for nearly everyone, and most people should have a base of their portfolio, at least in index funds, and then potentially have some individual picks on the side. Now, if we go to the bottom to the unique criteria of mutual funds, we can see mutual funds are actively managed. So there's a fund manager making buy and sell decisions within a mutual fund. The goal of a mutual fund is to beat market returns, not just match market returns like an index fund would or an ETF would, depending on the ETF. They have high average fees. They have the highest fees of the three here, with average fees of 0.82%. Now, you can find fees lower than this and higher than this, and they have the highest minimum investment amount, typically between $500 and $3,000. Now, if we look at the similarities between mutual funds and index funds down in the bottom right corner here, we can see that buy and sell orders are only executed once per day. So if you make a buy order for a mutual fund or index fund today, it'll be executed tomorrow at market open in most cases, where with ETFs, it's more similar to just buying an individual stock. You place that buy order and it just goes through right then and there. So I hope that this Venn diagram helps clear the air as to the differences between ETF, index funds, and mutual funds. What are REITs? Real estate investment trusts. REITs are a company that owns, finances, and operates income-producing real estate. So we can think of it as a combination of a dividend stock, because nearly all REITs pay out a dividend, a mutual fund because of the diversification factor and the pooling of investors' money, and a real estate investment at the same time, because REITs are actually buying physical real estate and then taking profits from it and paying it out to shareholders. So REITs allow investors to earn income off of real estate without actually having to buy or manage the real estate yourself. And you get a nice little piece of diversification along with it. Now, I made this diagram just to highlight the key features of REITs. So we can see we made a little pie here with a bunch of houses in it. With a REIT, you're essentially buying a slice of a real estate portfolio. Now, some REITs are targeted in that they may focus solely on single-family homes or commercial properties, and some other REITs are fairly diversified in different types of real estate within the real estate asset class. So you'll want to take a look at the particular REIT that you may be interested in to see what types of real estate they are investing in. So some key features here is it gives you exposure to a different type of asset class that you might not have exposure to, which is a good thing when you're trying to have a balanced portfolio. Typically with stocks, we have a lot of exposure to the stock market and to consumer companies. This allows us a little bit more of diversification and diversification within diversification, because if you, for instance, buy a single family home as an investment property, if for whatever reason that doesn't produce income for for the year because there's some issue at that property, you just don't make any income. However, if you buy a REIT, you're getting that small slice of many different properties, so you're more diversified. What this does is reduce the lower lows in terms of your investment and reduce the higher highs. You get a more stable return with a larger portfolio that is diversified. Also, this can be any kind of income producing asset, including homes, apartments, commercial real estate, hotels, hospitals, cell towers. As long as it's any income producing physical asset, there can be a REIT based around that thing. And shares of REITs can be bought at any brokerage, whatever brokerage you want to use, you can buy shares of any particular REIT. And 90% of the taxable income must be paid out to shareholders. So it's kind of unique in that nearly all of them, as long as there is income, pay a dividend and have to pay a sizable chunk of all their income out as dividends. So it's a bit of passive income as well. All right, we're getting there. We're nearly halfway through the Stock Markets for Beginners course, and you're getting a better and better understanding of different investment vehicles within the stock market, different options you have as a new investor. This is really exciting stuff. You should be proud that you've made it this far already. This is really exciting. In part 6, we're going to talk about risk and risk tolerance. We're going to give some portfolio examples on how to balance portfolios. We're going to talk about timing the market and dollar cost averaging. That way you get a little bit better at actually buying into your investments and getting a better cost basis when buying into your investments. You'll understand what all that means in part 6. So we'll see you over there. Make sure you like part 5 and subscribe to the channel, and we'll see you on part 6.